Welcome back to another episode of the Vet Worthwhile podcast. I am James Yost, partner and wealth advisor at SignatureFD, and I'm joined as always by my co-host Travis York, owner of 3-1 Advisors. Travis, how are you?
I'm doing great today, James. How about yourself?
I'm doing well. We are back with another episode of the Vet Worthwhile podcast. I'm coming at you live from the SignatureFD studios in Midtown Atlanta. Travis is back as always. He's going to be virtual today. Our guest is a returning guest, which is very exciting. It might be our first returning guest, Tony. Tony Welch, who's the Chief Investment Officer at SignatureFD. He came on several months ago to discuss the economic circumstances and how that affected small business owners in the veterinary community. So we have him back to give us an update and kind of check in, see where things are, where things are going, and see if he can provide some wisdom for all of our listeners. So Tony, thanks so much. Welcome back.
Yeah, thanks for having me.
Absolutely. So, Tony, one of the biggest things, last time we all sat down and did the last recording, inflation, I believe, would have probably been the number one concern for small business owners. You know, what has happened on the inflation front? Where are we now? Where is that ranking in terms of worry for small business owners?
Yeah, it's a good question, and you're absolutely right. You go back, look, inflation's peaked last summer at about 9%, and it's spent all of this time coming down from that level. And we've still kind of seen some disinflationary trends, right? So we actually just got August CPI numbers. You know, it's still in the threes. Inflation is still running in the threes year over year. That's not an insignificant number. But it's, we can handle it better. Small businesses can handle inflation with a 3 handle a lot better than they can handle inflation with a 9. So we kind of saw that from, we got this NFIB business survey recently as well. And they go ask small business owners, they say, what's your biggest problem right now? And inflation was top of mind for a very long time. And we're starting to see that pull back a little bit. It's still a problem. Don't get me wrong, but the single biggest problem right now for businesses is still kind of the quality of labor. So they're still kind of honed in on what's going on with the labor markets rather than inflation.
That's kind of interesting to me, Tony. Obviously, I think last time we talked, labor was a huge issue in the veterinary space, and I don't think it's gone away, but I think we're certainly starting to hear some rumors, at least in the vet world, that it's not as tight as it once was. Is that what you would expect based upon the data that you look at, or is that maybe unique in the veterinary space?
Yeah, so we have to kind of think about what they're asking in that small business survey. And when we talk about the quality of labor being a problem, a lot of that has to do with the significant time it takes to train up new employees, right? So, and they're paying employees more. So you're paying new people more, you're going to be thinking that the quality probably is a challenge for you at this point in time. But when we look at the availability of labor and hiring plans, you're absolutely right, Travis. Throughout the whole economy, we're seeing hiring plans have fallen back down to kind of pre-pandemic levels, and hiring trends have softened. So what that tells me is that businesses have staffed. They are staffed to what they kind of want to look like in the immediate future, but there's still a significant cycle for training these people, and they had to staff these people at kind of higher levels of wages.
No, and I think we're seeing that across the board, right? Like we used to see, the cost of labor inside a veterinary hospital that it was really well managed, running at like 43% of revenue. And now you're seeing that in well-managed hospitals push 46%, 47% of revenue. So, I think that, that's definitively true inside the veterinary hospital, realm. Kind of another thing, Tony, not to pivot off of inflation, but, obviously interest rates, you kind of connect the two together, right? Because the Fed's always talking about inflation's up, we got to raise interest rates. Two-pronged question for you on that, thinking about it from our listeners' perspective. One, like interest rates go up, they're hoping that they slow consumer spending. veterinary hospitals are really reliant, on consumer spending. Do you think we have seen, how do you see these higher interest rates and how long they stay high impacting consumer spending? And, if there's any insight you have on veterinary spending, what, any insight you have there for us?
Yeah, a couple things. One, let me just stick on labor for one additional point. Is as we look, we're seeing that everywhere, where labor is a higher input cost now. But I don't think that wage increases are going to continue at the level that we saw over the last couple of years. So what needs to happen for all smaller businesses is they need to expand profitability in other ways, right? And how are we going to do that? We're going to do that by picking up productivity, right? So that's what everybody's looking at doing, is taking these expensive laborers, making them more productive, driving the revenue line higher, and then you can kind of re-expand margins. And I think that's what everybody's looking to accomplish now that kind of the job markets are settled out. Now, we think about inflation and the interplay to interest rates. It's been kind of fascinating, right? So interest rates, short-term rates are set entirely by the Fed. And the Fed has a dual mandate of stability in employment and stability in inflation. Well, employment has been fine. So their sole purpose in life right now is trying to tackle inflation. And they can really only do that through trying to destroy demand. Well, what's been interesting in that is the bond market was telling us about mid last year that, hey, the Fed is picking up short-term interest rates, and they are, in fact, going to destroy demand, and they're going to throw us into a recession in 2023. And what ended up happening is this phenomenon of a negative sloping yield curve, where short-term rates were higher than longer-term interest rates. That's not a normal condition. That's the bond market saying the Fed is going to tighten things. We're going to go into a recession. Well, what's been interesting this year is those short-term interest rates have not really bitten economic growth. Economic growth has actually been a bit stronger this year than anybody would have forecast. So we're starting to see longer-term interest rates come back up, right? In other words, the bond market saying, okay, well, maybe recession isn't an immediate concern, and longer-term rates should be about where shorter-term rates are. So we're starting to see that adjustment. And what I think it means is I think we should all expect higher interest rates for a longer period of time than we may have expected last year. So in so much as rates drive the cost of capital higher, are kind of a headwind to businesses, to capital, we should expect that it's going to be a more challenging environment with higher interest rates for a longer period of time.
So I know I talked a little bit about the consumer side of things, Tony. I mean, on that, obviously a lot of our listeners have only been exposed to really low, like historically speaking, interest rate environments. So, just thinking about people like veterinarians who own hospitals who are borrowing, long-term fixed interest rates now are, ranging 6.5% to 7.5%. From your perspective, I mean, you expect those to kind of sustain, and some of the sentiment is those are like almost like usury, like mob rates. Like historically, can you just kind of give some perspective on, a 6.5% to 7% interest rate?
Yeah, Travis, I think that's there's great context in there. So interest rates in the Treasury, which Treasury rates are basically going to be the base rate that everything else is set off of. It's going to be kind of your cost of borrowing. We're right around like 4.5% is a very normal environment for Treasury rates. And then for business borrowing, there's obviously going to be a spread to that. So rates of 6.5% or so is not historically abnormal at all. I think to your point, the aberration historically was 0% interest rate. That was the historical anomaly. Where we are today is a lot more normal based off of where we've been before in the past.
Yeah, that's helpful, Tony. And you talked about interest rates in the bond market and what it had forecasted for 2023 with an inverted yield curve. I mean, what ended up happening this year from an economic perspective? Like, what has happened? And then what are you thinking going forward? Like, what is the data telling you about the next few quarters? Because at this time last year, I mean, my recollection was like 9 out of 10 economists were forecasting recession in 2023 and significant economic slowdown. What has actually happened? Because I think there's a lot of confusion out there.
So it was absolutely, you're remembering absolutely correctly, James. Economists were forecasting recession, and that's because they were looking at traditional leading indicators that picked up on past recessions, but we have to remember that every economic cycle is different. So let's pivot back to something that Travis was talking about, he was talking about the very, very low interest rates that we had over the course of the last 10 years. And I think what people got wrong going into this year is that they believed that higher interest rates were going to be a negative on consumers. Well, in fact, the exact opposite has happened. So let's think about consumers and the position they were in coming into these higher rates. So since the global financial crisis, consumers have been deleveraging their balance sheet. Actually, household balance sheets are in about the best position that they've been in years right now. So they've been deleveraging their balance sheets. They had a lot of pandemic savings from those stimulus programs that got enacted. So they had a cushion, a savings cushion. And think about their debt position. Most people's biggest debt burden is their mortgage. Well, you go back and you look around and you say, okay, well, what's the average mortgage rate right now? The average mortgage is like 3% out there. So even though the Fed has been lifting interest rates and new mortgages are 7%, there's not a lot of that happening. People still have 3% debt that is termed out for the long term. So actually what's been happening is higher money market rates, higher rates from the Fed have actually been a net stimulus, especially to the high net worth crowd who have a lot of savings, because now they're getting paid a nice interest rate on their cash and they don't need to hit the debt markets right now. So you look at what's gone on with the consumer this year, it's been really fascinating that consumption has been very strong. And a lot of economists were forecasting that the higher interest rates were going to weaken consumption, but instead consumption has actually been pretty strong.
That's interesting. Now, do you kind of looking at the data that you see, Tony, and I mean, obviously at the end of the day, they have to slow spending to control some of these inflationary pressures that are out there. Do you see consumer spending staying strong going forward? Or, I mean, again, and this kind of gets into this, like, you know, is it going to be a soft landing type of recession where they somehow kind of figure out how to bring it down smoothly and there's not like this abrupt stop? Or is there still a likelihood that we could see what everybody was thinking was going to happen in 2023, which was like this abrupt stop of spending?
Well, Travis, I'll tell you that in every economic cycle, people think that it's going to be a soft landing, right? There's never something that says, oh, you know, no, there's not a lot of data out there that says it's going to be a hard landing. And by hard landing, all we mean is that unemployment picks up meaningfully. I don't think this is going to be any different. Eventually, when we do go into an economic contraction, it's going to feel like a hard landing, not a soft landing. I think a soft landing is a bit of a fairy tale. I think what we need to look at, though, is how far down the road is that? And I think it can be a lot further down the road than people anticipate. And the reason I think that we may not have recession for a while here, maybe beyond 2024, is a lot of these labor dynamics. I mean, all of your listeners probably had to work pretty hard to get labor in the door. They're currently training these people. It is a significant commitment from businesses. They are not going to be quick to let employees go, even if their margins are taking a little bit of a hit. So I suspect that most businesses are willing to take on a little bit of economic pain before they start to let their employees go. And that's what really drives an economic recession, is that spike in unemployment. And I think it could be a while before we see that.
Tony, let's talk about something that's related to all this stuff that we haven't really touched on yet. And most of our listeners are either hospital owners now, they are aspiring to be a hospital owner, or maybe they've actually already sold their practice. And all of that, where I'm going is on the kind of mergers and acquisition space, the private equity space. So last time we talked about this, I mean, there's a lot of private equity capital that's come into the veterinary space over the past decade. And really, we're buying up a significant number of hospitals through 2019 to really kind of early 2022. Multiples shot up. They have come back down. And I think most people know that. But like, just curious to get your take on the current landscape for mergers and acquisitions, and then kind of what you're seeing on the private equity side. I maybe even throw in some information on IPOs, as that is relevant now to this group with some of these veterinary consolidators.
Yeah, listen, so we run a private equity fund at SignatureFD. So we've got some great insight into PE as investors, right? So I can definitely speak to what we're looking for as investors and what we're seeing from the fund managers that we work with. So I'd say broadly, private equity has been fascinating, and your comments about private equity being more prevalent in the vet space is very interesting, because if you look at historically, private equity has been very focused on technology. Something like 36% of all private equity investments are in the technology sector. And you look at just publicly traded smaller companies, 12% of those are in tech. So that kind of tells you where the private equity money has been going historically. But we have started to see it change a little bit, where PE is starting to wade into the service industry, wade into healthcare in particular, a bit into industrial. So it is an interesting trend. I think that they've identified that these are great cash flowing businesses, and they can come in and add a little bit of operational efficiency and unlock a little bit more value. So that's what we've kind of seen from just like a broad dollar allocation space. Now, to your point, multiples have come down a bit. Deals have slowed down, but multiples are still higher than where they were pre-pandemic. So they've softened, but it's not catastrophic or anything like that. They're not recessionary multiples that are being paid right now. It should come as no surprise that multiples have come down a little bit, because the cost of capital is higher. And that's what really matters for these folks. Now, when I look at the PE landscape broadly, right, it's estimated that PE has some $1.3 trillion left to deploy. That's a large number, right? So there's a lot of dry powder out there in PE still. But as for what they're doing with that this year, there hasn't been a lot of new buyout activity. Actually, when we look at like new buyout activity, it's at the lowest level it's been since 2007. There's been a lot more money, to your point, James, a lot more money is going into add-on investment into existing companies, and the way they're exiting in terms of the M&A space, they're exiting deals more through selling to another company, or they're exiting through selling to another PE firm. We have definitely seen the IPO market slow down quite a bit this year. Historically, just for context, about 18% of all PE exits were public listings, were new IPOs. So far this year, it's been 3%. There's been hardly anything from an IPO perspective. It's just not a good market for public IPOs. So we are seeing more of that acquisition activity going on for the exits in PE.
And when you talk about acquisitions, Tony, are you seeing more of a scenario where an existing company in the space, whether PE backed or family capital backed, steps in and acquires a similar like kind business, maybe to grow their footprint or grow their product set? Or you see it, because I thought I heard you say that you're not really seeing a lot of new money flooding into to unknown spaces right now.
Yeah, that's right. So we have seen buyout activity down. It's still happening, Travis, right? But as a percentage of what is being deployed, it's lower. But to your point, that is what we're seeing for exits. So take a PE-backed company, and they need to monetize their investment at some point. In the past, you have seen that a lot more through IPOs. But now what you're seeing, at least in 2023, is exactly that. Is it's selling to a larger corporation, oftentimes PE-backed, in order for them to grow their practice.
Yeah.
I think
ahead,
obviously
Travis.
I just want to make sure everybody kind of, from our listener standpoint, who don't deal in this space all the time, what you're really speaking of more there, Tony, is you're seeing a bigger fish step in and kind of eat a smaller fish. And it's less of what we were seeing in the veterinary space in 2019, or maybe say 20, 21, 22, which was a brand new entrant coming in and buying an existing business to start building in that space. Like a brand new private equity firm may not come in and be as likely to come in and buy an existing group of hospitals today.
Yeah, they're focused on, and again, there is some of that going on. There is some new buyout activity. But what PE firms are very focused on in 2023 is improvement in their existing company platforms and growing, firms that they already have investment in.
Yeah, Tony, it's funny you mentioned that. And last time you were on, I know, we talked about some of these different dynamics, and you had mentioned we all talked about multiples coming down. And your point was, well, they can come down, but if you can go in and actually improve profitability, improve operations, ultimately you can still get to the same outcome. And, that's definitely something I've heard, at least anecdotally, from a lot of our clients, is that some of these operators have come in, and even though they're not maybe on the buying path and they're not paying top dollar for multiples, I mean, they're really coming in and reducing cost of goods. They're reducing, in a lot of cases, hiring, increasing the top line, and just adding to profit, like efficiency during this time where there's not as much transactions happening. So that's interesting.
So and James, just to speak to that, and like I said, we're end investors, right? So we are evaluating managers and their strategies. And as an investor, that is probably the top thing that we are looking for in a manager these days is, how did you build your track record? Was your track record built on the back of leverage and cheap debt and ever increasing multiples? Or are you actually able to go in and add these efficiencies and drive fundamentals higher for a business? And that's been very important to us as investors.
Yeah, that's good to know. I mean, I think that's really helpful for folks to hear. Travis has mentioned it a few times on the consumer spending, consumer sentiment side. And I think there was a new report that came out this week on small businesses, maybe their attitude and towards this economy and ability to hire. What's the latest news on the small business front?
Yeah, I would say, so the interesting thing about this expansion, I've heard somebody call it, and it resonates with me, the bad vibes expansion, right? We've been in economic expansion, but sentiment has been terrible this whole time. And look, if you're a small business, I'm not going to lie and say it's an easy environment. It's not an easy environment. You have a situation where inflation is a little bit sticky. Employment has been hard to get. And look, we have an economy that the potential growth rate of the U.S. economy is about 2%. That's not exactly gangbuster growth that every small business does well in. Fortunately, it's not a black and white story. There's a lot of shades of gray in there, and there's winners and losers in kind of a slow growth, higher interest rate economy. So I think you're generally seeing that in small business sentiment. Small businesses, even though earnings have gotten better in real time for small businesses, their expectation over the next 6 months is pretty dour. And that's what we saw in the NFIB survey, is that they expect the next 6 months are going to be challenging for them on net. So again, it's not an easy environment for small businesses, but it's not the worst environment for good businesses either.
Interesting. So you said in, kind of this type of environment where, you have small businesses that are successful and small businesses that struggle. Are there any profiles, Tony, that tend to, is there a business type, right? Is it a higher end consumer business that tends to do well? Is it a middle of the road for like our listeners as they're kind of thinking about, strategizing on their hospital? Where does consumer spending usually drift in this type of environment?
Yeah, with the consumer, I think we can talk about sentiment as well. Consumer sentiment has not been positive either. And I think that this is the type of thing where we have to kind of watch what they do and just keep in mind what they say. But as long as consumers have a job and their incomes are generally going up, the U.S. consumer is going to consume. And I think our outlook being that the expansion can go longer than people expect, I think the consumption patterns are going to be sticky as well. So service businesses, higher end service businesses, all of these things can do well in this environment. And of course, there's going to be challenges from an economic perspective. I think the unique thing about much of the healthcare space, the veterinary space, is a lot of the spending could be sticky even in a recessionary scenario.
Yeah, that's interesting, Tony. I mean, and there's a lot of our clients, a lot of our listeners, the varying types of hospitals that they own, like with emergency services, specialty services, which are more high dollar, tougher decisions, I'd say. And then just your traditional general practice, small animal hospitals. So it definitely varies on the impact from like an economic contraction. But, ultimately, it sounds like what you're saying is we're likely to see consistent consumer spending. Healthcare is fairly resilient, which is probably good to hear for our listeners. Now, you started to forecast a little bit there, like you started to step a little bit into the future. And I know nobody's got a crystal ball here, and we're not going to put you on the spot and force you to give us hard numbers. But when you're sitting down with business owners, small business owners, and speaking about all these topics we cover today, which is pretty broad from an economic perspective, but and they ask you, where are we going from here? How do you respond to that? And what are your thoughts?
The first thing that I like to tell people is we forecast for fun. So where we go from here is anybody's best forecast, but where we see things developing is, one, we are removing some consumer support, right? Things like student loan forgiveness is starting to expire, and student loans are going to have to get paid again starting here, I think, in October. You are starting to see pandemic savings start to wind down a little bit. So you are seeing a little bit of the consumer support start to drain as we get towards the end of the year. But there's other things in 2024 that start to turn on from an economic perspective. And it's particularly around infrastructure spending. So some of the bills that have been passed in Congress is going to start boosting the infrastructure investment side of the economy. So what we kind of think, again, is this is going to be potentially a stubborn economic expansion. Businesses are not necessarily keen to let go of their employees. As long as there's employment, then consumption continues to march along. And so we still think that it's an economic expansion. So if I can kind of translate that to financial markets, as long as the economy is in decent shape and it's expanding, then we shouldn't really expect large bear markets. It's pretty rare to get very debilitating bear markets in stocks without an outright economic recession. And we actually had one of those in 2022. We had a little bit of a bear market without an outright economic recession. That's not super abnormal for things, but we're starting to recover from that from a market perspective. So kind of our crystal ball says the economy is fine for now. Markets are fine for now. I wouldn't expect, the types of investment returns that we saw in late 2020 and 2021, but everything looks okay to us. Of course, there's cracks, and that's going to happen when you've got interest rates rising as quickly as they did. That's going to happen when you get normalization of things like we've had from the pandemic and all the craziness of the pandemic. But on net, things look like they're fine for now and potentially well into 2024. That's
a pretty good note for me, Tony. I mean, I know, James can tell you I'm always kind of one that probably looks at it and is like, man, they're like the hammer's coming. And so to hear you say that the data would indicate, that at least it's a little bit down the road. And, for a lot of people who are thinking about creating exits for themselves or thinking about starting hospitals, it sounds like overall the news and the sentiment is still really positive, and you're still positive on healthcare spending. And not that we're telling anybody to go out and dive right into it, but I mean, this was a very encouraging message to me. And, I hope we can maybe do this more frequently and you can continue to bring these positive notes to us.
Well, I'll only bring the notes that I see in the data, Travis. So if things start to turn south, then maybe I won't be as positive for you. But
we just won't invite you back then, Tony. We just won't invite you back then.
That's
too funny. Love it. Well, awesome. Thanks, guys. Tony's the Chief Investment Officer at SignatureFD. Thanks again, Tony, for coming on and spending some time with us and sharing your insights. Travis, as always, great to be with you. Thanks for the listeners for checking us out and tuning in, and we'll see you next time. Thanks again for tuning in to the Vet Worthwhile podcast. You can find us online at signaturefd.com/signature-veterinary. And then our ask would be, if you found this episode valuable, just think of one friend or colleague that you think would enjoy the content and just please share. So thanks again. We'll see you next time.
Travis York is the owner of 3-in-1 Vet Advisors and a partner of SignatureFD. 3-in-1 Vet Advisors is a veterinary consulting and strategic planning firm of which SignatureFD has no involvement or ownership. James Yost is a partner and wealth advisor at SignatureFD. SignatureFD is an investment advisor registered with the U.S. Securities and Exchange Commission. 3-in-1 Vet Advisors and SignatureFD are not affiliated. Mr. York provides all non-investment advisory services through 3-in-1 Vet Advisors. The opinions of the guests and the contents of this podcast are intended to be educational only and should not be relied upon as investment, tax, business, or planning advice. You should consult with a professional advisor prior to taking any course of action that may impact you or your business.